Good morning and welcome to today's webinar about transfer pricing documentation in Denmark and Germany. We are pleased to have our tax partner BDO with us today. From BDO Germany, we have Richard Wellman, and from BDO Denmark, we have Arne Ries and Christian Finko. And before I hand over to BDO Denmark, I will shortly mention a few practical information and the program. The webinar will be recorded and you will get the recording afterwards together with the presentations. And during the webinar, you can ask questions in the chat and we will then take the questions after the presentations. And when we take up your question, you will be able to unmute yourself to elaborate on your question if you like. And now for the program, Arne Ries from BDO Denmark will introduce BDO Denmark and the International Tax Service. And then we have Christian Finko, who will tell us about transfer pricing documentation in Denmark and regulations. And then we have Richard Wellman from BDO Germany, who will go through the transfer pricing documentation in Germany. And in the end, we have half an hour for questions. So please ask all the questions you want. And now I will hand over to Arne Ries and Christian Finko from BDO Denmark. Now we have Arne with us and Christian. We'll just take a minute to get them on with their presentation. I see Arne, but I don't see Christian yet. But I know he's there. If you just have some patience.
Thank you, Nina. We just need to get the presentation started.
Yeah, no problem. We have time for that.
There you go.
Yeah.
Thank you.
Yeah, the floor is yours.
Thank you. Thank you, Nina, for having us today. And good morning to everyone. My name is Arne Ries, and I am the head of the International Tax and M&A Tax Practice in BDO Denmark. I will come back in a minute to what that means. But briefly, just a few words about BDO to those of you out there who would not know us extremely well from your everyday life. BDO is a global advisory and audit firm. We are present in more than 160 countries. We are more than 90,000 people worldwide and offer a broad range of services, including tax services. On the tax side, I think my German colleague Richard will come back to how we operate and work together in our daily life. But basically, we are a global tax organization as well. On the tax side in Denmark, we have a tax department based in Denmark and in Copenhagen, but spread out among a number of offices in Denmark. And we are divided into a number of business lines, one of them being our International Tax Services Office. And we are the people that on the issue that we're dealing with today, transfer pricing is the group of people that you will normally be working with on transfer pricing matters. The International Tax Service Department in Denmark is divided into sort of three sub-service lines, one being transfer pricing, because it's a very important business area in Denmark. The second being the broader global international tax practice. And then we have our M&A transaction tax practices as well, all in one unit. They have the common denominator that it's generally dominated by cross-border issues in general, where taxes has become a more and more relevant factor during recent years. International tax becomes increasingly difficult. It is increasingly important to be transparent on your international tax, and the authorities in various countries work together in an increasing degree, and we need to sort of match that reality when we service our clients. And transfer pricing is indeed a very good example of how more than one country needs to make sure that the transactions that are in place in a group is indeed carried out in a manner that makes sure that every country gets the tax revenue that matches the activities that take place in their jurisdiction, and we need to help clients deal with that reality. In our team, it is myself and my co-partner Vicky who are the tax partners of our team, and we are fortunate to also have Christian Finkel as a director on the transfer pricing side, being our lead specialist there, and Christian will be taking over in a minute. But this is the team. In Denmark, we are about 15 people in our international tax services team that are able to help you on the Danish side of being present in Denmark while having an international presence as well. So with those words, I think I'll hand over the word to Christian, who will take you into a bit further detail about the international and the whole transfer pricing documentation elements of our practice. Thank you.
Well, thank you very much, Arne, for the introduction. We try to focus our presentation today for clients and other spectators having businesses in both Denmark and Germany. We would mainly draw our attention to businesses having activities, the headquarter activities in Germany, and then trying to start up business or already having business in Denmark, in order to make sure that we touch upon the important matters. So Arne just went through the introduction, and in the next minutes I will be talking about what are the requirements in Denmark on transfer pricing in general. Then we will discuss what is new within transfer pricing, and how are the Danish tax authorities operating, and how are they setting up for the future. We'll also go into the specific documentation requirements in Denmark, and lastly we'll talk to you about how the good process is in working with transfer pricing documentation in general, but also with transfer pricing, which is an ongoing matter, not only preparing files, but also working with transfer pricing on an operating level. So firstly, I'd like to talk about the history within transfer pricing, the rules. The arm's length principle, which transfer pricing is about, has been around for some time now. The arm's length principle was implemented in the late 90s in Denmark. However, the specific requirements of how to document the arm's length principle was not present at that time. Later on, we had specific rules in the Danish executive order specifying that documentation would have to be prepared and how it actually was supposed to look like. Then in 2012, rules about penalties was introduced. I'll get back to how the penalties work and what are the risks within transfer pricing. In 2016, we saw the OECD issuing BEPS reports, base erosion and profit shifting, These reports included 4 subjects within transfer pricing. It was a more holistic work in the OECD. However, these 4 subjects were specific targeted on transfer pricing. Action 8 and 10 was targeting specific subjects within setting the prices subject to arm's length, and then action 13 was targeting the documentation itself. Following up on the BEPS project, these rules were implemented in Denmark in the following years, from 16 to 18. The newest part in Denmark is that we would have to prepare and submit transfer pricing documentation automatically without any request from the tax authorities. And the last issue we see here in Denmark is that from 2022 we now also have to prepare benchmarking studies on transactions to support the arm's length nature of the transactions. So to set the scene, I'd like to just briefly touch upon the arm's length principle. So the general rule is that when looking at transactions between affiliated parties, these transactions would have to be priced in the same way as between independent parties. So that is at market prices. In Denmark, the tax authorities are very focused on guidance from OECD in order to make sure that price setting is analyzed in the same way in both sides of the transaction, that being in Denmark or in Germany, for example. And therefore, the OECD guidelines are an important part of a transfer pricing audit here in Denmark. They are really focusing a lot on comparability studies and the use of data to support the narrative around the transfer pricing policies on each and individual transactions of the Danish entities. So their starting point would obviously be the Danish entities and the tax return. How are the transactions priced? But they will also have a holistic approach to the way the transactions are priced. It's important to say that a transfer pricing audit in Denmark takes a lot of time. Normally, we are talking about 2 to 3 years of a transfer pricing audit. That's on average, and that is why that is because we have a lot of information exchange with the Danish tax authorities on such an audit. We'll get back to you on the process on later on in time in this presentation. Normally, when we talk to our German-based clients, we find that the Danish transfer pricing rules are much stricter than they are in Germany. It's not because of the way the transactions are priced in general, but more the interpretation and how the tax authorities operate, but also the penalties in Denmark is something that is new to clients in many countries, and also in Germany. in our view, it's because the consequences in other countries than Denmark is of less important. When you prepare a documentation and forward it to the tax authorities, we don't see such harsh consequences for not having the appropriate quality than it is in Denmark. So the penalties are based on two subjects. One being if we provide misleading information to the tax authorities, misleading information about when are we supposed to prepare transfer pricing documentation, and are we above or below the thresholds? If we are providing misleading information about that might lead to penalties. Another way of getting these penalties, or getting into the penalty regime, is if we prepare a transfer pricing documentation in a poor quality, or if the deadline of submitting the transfer pricing documentation are not met. The deadline for submitting documentation is 60 days after the deadline of the tax return, and the deadline of the tax return is normally 6 months after the year end, the financial year end. So you would have 6 months plus 60 days to submit the transfer pricing documentation. The amount of, sorry, I forgot to change slide. The amount of penalties, we do, just to make it clear, we don't have that much case law at the moment, but the guidance says that we are looking at a penalty of 250,000 Danish kroner as a starting point per legal entity per financial year, plus a 10% penalty tax on a transfer pricing adjustment. The fixed amount of 250,000 can be reduced to 50%, i.e. to 125,000, if sufficient information are provided to the tax authorities after the submission date. So last year, the Danish tax authorities opened up a new office. The office is focusing on data and analyzing data submitted by the taxpayers and advisors. This office is employing many different people. It's people within more or less general tax matters. They are specialized within international tax, also normal corporate income tax, transfer pricing, but also IT, normal IT programmers and engineers and data experts, and also financial experts. They are focusing on trying to mitigate aggressive tax planning, and they are looking at any type of risks which might be in the data received, in order to start up and monitor the taxpayers. They are also focusing on developing new ways of having audits in Denmark, through digitalization. So for now, we know that they will obviously be looking a lot into transfer pricing documentation, but this office is also focusing on how to develop new methodologies within audit, within tax audit itself. So the purpose of this office, you could say, it would be to undertake controls of international tax with focus on aggressive tax planning, ensure the best possible use of data, analysis of tax planning models, and choose the right cases in their perspective, the right cases for controls and transfer pricing audits. It's fairly common that we see transfer pricing audits start out with submitting transfer pricing documentation, but not leading to an adjustment. And therefore, to minimize the burden, they are also focusing on analyzing their data before reaching out to the tax authority, to the taxpayers. As I said before, 2000 and the financial year 2021 is the first year where we would have to submit a transfer pricing documentation. For now, the tax authorities have issued a statement that 5,500 transfer pricing documentation have been submitted, and the expectations are 8,500 for the full year. So as many of companies and businesses have calendar years, then the deadline was in August, and therefore the 5,500 documentation were submitted, which were submitted this summer, is not entirely what was expected. The 5,500 is roughly equivalent to 65% of the total expectation. However, and therefore the last part of the expected documentation should be submitted within this year. Then just to let you know a little bit about what types of data this new office expected to look upon. We have these bullets. So maybe Arne, if you could take us a little bit through what this is about.
Yes, certainly, Christian. I'll just highlight a few of them. As Christian mentions, this office sort of builds on various data that is currently, if you will, being a part of the various international projects going on in the tax arena these years, leading to a lot of data being exchanged between tax authorities, as I was alluding to initially. As some of you may have heard of the BEPS project, the base erosion and profit shifting project, being sort of the most ambitious international tax project I believe ever conducted, initiated by OECD, that has led to a number of these initiatives, including exchange of information between tax authorities. A lot is also going on the EU level. You have EU's cooperative compliance program, being a program that has led to corporate tax documentation being exchanged. You have the country by country reporting, the CBCR, that is part of the transfer pricing documentation being shared for large multinationals. You have in Denmark a Danish, if you will, project called Operation Money Transfer, where you have certain credit card information being provided to the Danish tax authorities that they have acquired abroad. And then you have all which are also EU projects, the Directive of Administrative Cooperation, the DAC projects, DAC 2, regarding exchange of information of financial accounts, also including the FATCA from the US, the DAC 3, where where every time a European tax authority issues a binding ruling, a private letter ruling regarding a tax position that has an impact across border to another jurisdiction, those binding rulings are being exchanged. The DAC 6, I believe many have been acquainted with in recent years, where advisors are obligated to report to the tax authorities on certain transactions which have certain hallmarks that may be considered to be where you could have transactions that may be considered as being abusive for tax purposes, that needs to be provided to the tax authorities. Most recently, the DAC 7 information obligations for digital platforms that need to report activities and provide certain tax reporting regarding those when you are operating a digital platform, and a number of other projects leading to a lot of information from being provided to the tax authorities and eligible for exchange with other tax authorities. So sort of creating additional, at least from the tax authorities side, additional transparency and a lot of data to be, available for analysis with the tax authorities. And this is the unit in Denmark that deals with this. And we should expect that could lead to, at least going forward, increasing number of initiatives to make sure that tax assessment in Denmark has been correct.
Thank you for that, Arne. And that leads us to the next point, where would like to take you through how a transfer pricing audit works now, and how we expect it to be going forward. So historically and for now, it has been the case that the tax authorities has less information than they will have going forward. Now they will really have a lot of information when they reach out to us. So historically, when the tax authorities were reaching out to the taxpayer, they knew they had fairly limited information. They obviously had the tax return and financial accounting available, and then they also have Google available, so they had the information in medias and on the internet. That was it. And a transfer pricing audit would always start with a visitation period where they would go through whatever material they would have, and if they saw any risks from their perspective within transfer pricing, the taxpayer could expect to receive what we would call a 60 days letter, which is basically an request for submitting the transfer pricing documentation. Then BDO and the taxpayer would be working on the transfer pricing documentation for 60 days and submit it, hopefully within the deadline. And then the tax authorities would have time to go through the documentation and ask further questions. And this process, the audit process, would be what we would normally expect to be between 2 and 3 years. So information back and forth. We would also have discussions, meetings with the tax authorities. We would, and if they come to the conclusion that they see that the pricing should be done differently, the pricing of the controlled transactions, then they would issue a letter of where they would make it clear that they intend to change the income subject to the control transactions. Then we would have time to get back to them with our thoughts of how we see it, and then in the end they would come up with a verdict. And depending of the risks, depending of how we would like to act upon that verdict, the taxpayer would have two different approaches to how to mitigate the risks. The verdict would obviously lead to a double taxation issue. So if the main purpose for the tax authorities, the client and the taxpayer is to eliminate the double taxation, then it might be preferable to go into the MAP process where the tax authorities would go together. So in this case, the Danish and the German tax authorities would sit together in a meeting and discuss the pricing of the controlled transaction of the particular taxpayer. And then they are expected to reach to an agreement where they would eliminate the double taxation. However, if we see that the verdict and the ruling are more principled, and we cannot live with the way that the tax authorities have approached the pricing, then we can also go into the legal system. But please bear in mind, if choosing this approach, it should be noted that there's not much case law, and these cases might go all the way into the Supreme Court, which takes about 10 to 15 years. So that's the old process of transfer pricing audit. We believe that going forward, the tax authorities has much more information available than they used to have. We would expect them to be much more that when they reach out to us, they are much more prepared than they used to be when we have the initial meetings and when we submit the documentation. And that is because obviously they have the same information as before, but now they also have new information which Arne just talked about. Normally, we would see them have been analyzed in the master file, local files, and if we are in a certain size, then also the country by country reporting to understand the full the transfer pricing policies of the group and of the Danish taxpayers. So hopefully the audit processes would be shorter, but we would also expect the tax authorities to be a little bit more focused on the case itself and the arm's length discussions, whereas before it was a lot of discussions about information exchange and so on. So it might lead to some shorter cases and shorter periods of these transfer pricing audits. So obviously the central part of all this is to make sure that we can prepare transfer pricing documentations in a good way, in a good quality to mitigate the risks of any misunderstandings and to argue why we believe that we have been trading at arm's length. But there's a threshold within when you would have to prepare a documentation itself. We have three points or three trigger points which would lead to having to prepare transfer pricing documentation and to submit them. The first trigger point would be if the group is employs more than 250 employees at a group level. Another trigger point would be if the group have a revenue of more than 250 million Danish kroner and a balance sheet of 125 million Danish kroner. These two financial figures would be both of them would have to be present if you were to trigger that point. And lastly, if the Danish entity have controlled transactions with affiliated entities outside the EU, in a country outside of EU and with no double taxation treaty, it would trigger a transfer pricing documentation requirement, no matter the size of the group. It's important to state that all these figures are based on a group level. Lastly, if we deal with groups, multinationals, multinationals, but having transactions domestically, then you would not be subject to transfer pricing documentation. So if, for example, if you have a holding company with no transactions, no cross-border transactions, that company would not be subject to documentation. So historically, we have been asked a lot of times. So what are the minimum requirements here in Denmark? What can we do to make sure that we are compliant with the rules, and we don't get into any penalties? It's a difficult question to answer, but we have tried to split up the main risks within transfer pricing. So if you consider this figure, then we have two kind of risks. One risk being penalties, and the penalties are issued based upon poor quality of the documentation itself, i.e. the reports prepared, or if the reports are prepared are forwarded late. The other type of risk within transfer pricing is is the double taxation. If the taxpayer is pricing the transaction in a way that would not occur between independent parties, then there would be a risk that the entity, the group is double taxated. So obviously, we would like to minimize both types of risks, but that's the model that we normally would see, and for starters, normally the risk of penalties is the most immediate risk. So what should be included in the transfer pricing documentation? So transfer pricing documentation consists of two separate reports. Both reports would have to be submitted to the tax authorities. One report is what we would call a master file, and the other one would be the local file. it's required to have a local file for each individual Danish entity, and the master file will be on the group level. The main points which should be included in the master file are an overview of the legal structure of the group and a description of how and where geographically the group is operating. So not only focusing on Denmark, but where in the world are the group operating. It's also important in the master file to disclose the full value chain of the main products of the group, and a general description and industry analysis of the whole operation of the group. There's some special considerations regarding intangible assets, and financial transactions, which also should be included in the master file. It's important to state that this is not the full list, but this is the main areas which should be touched upon in the master file. You could say the main purpose of the master file is to provide a full overview of the main transfer pricing policies of the group. So on the local file would be, a more specific focus on the individual taxpayer in Denmark and also in the rest of the world. It's the same approach in all OECD countries, that you would have a master file and local file, and the local file should be including the way the specific entity is operating, and management structures and organizational structures of the specific entity. It includes the local file includes a description and identification of all intergroup transactions, and it is in the local file where we would have to conclude that the specific transactions are prepared and priced according to the arm's length principle. That involves comparability studies, functional analysis, and benchmarking studies. So, if we think back to the previous, sorry, Nina, I'm not sure if we can see the full slide here.
I think we can. I see some tables and some text. It looks fine to me.
Okay, so the right side, it's possible to see everything.
Yeah, I see. I think so. Yeah.
Okay, good. Thank you. So looking at when we asked what are the minimum requirements of a transfer pricing documentation, then it's again, we don't have that much case law, but historically there's been a lot of focus on minimizing the penalties, and therefore it would be the starting point for many businesses is to make sure that the documentation are prepared in a formalized way. So looking at the formal requirements of the documentations, rather than whether the transactions are priced according to the arm's length principle. But looking at and therefore we include this example where we see historically have seen a lot of documentation describing the transactions. In this example, we are selling some goods from a production entity. We have identified the counterparty. It's the tax jurisdiction is in Germany, and the price is the pricing policy is based upon a cost plus 5% method. Assuming that the method is correct and so on, then the conclusion in the documentation is stating that based upon the above consideration, management of the group has concluded that the transactions are priced according to the arm's length principle. So the policy, it might be correct that the policy cost plus 5 is correct. However, we don't really have the required comparability study to support our conclusion. And looking at what is the full purpose of the transfer pricing documentation, that is where we might get into trouble going forward, as we expect the borderline between a sufficient and an insufficient transfer pricing documentation would be focusing on the purposes of the documentation. And the purpose is obviously to document that the transactions have been priced according to the arm's length principle. So an example of what should be included in the documentation is the same as before, in our view, that we identify the transaction and we identify the methodology behind and the policy, but also have some data available, data which is based upon transactions between independent parties. That might be a benchmarking study or other intergroup other transactions between the group entities and independent parties. It's important to state that these transactions would have to be comparable, of course. So in this example, we have looked at the data. We have a range. We would take the middle 50%, what we would call the interquartile range, and we have identified roughly 1.9 to 7%. That's our arm's length range. And when we look at the transaction which has been priced upon a cost plus 5, the cost base might be costs based on budgets and so on. So we would look at the actual outcome, what will have the actual cost been during the year. And in this example, we can conclude that then looking at the actual cost and the actual income subject to the transaction, then in reality, the method has been a cost plus 4.5%. And when we look at the 4.5%, we can conclude that that this is within the range of the benchmarking study, and therefore we can conclude that the transaction have been applied according to the arm's length principle. So going forward, it's a matter of using more data to support our conclusions. And that leads me to the next point, that the newest part, as I said before, the newest requirements in line of all these requirements are that if the method if it is relevant for the transfer pricing method, it is required to prepare a database search and a benchmarking study to support the arm's length nature of the transactions. So in reality, that also gives us some challenges, because we don't know the actual outcome of the transaction until the year has ended and we are into next year. The financial figures have not been audited or anything, so that would and therefore we would also have to apply what we would call a year-end adjustment. So, and to make sure that this is compliant in all local jurisdictions, it is required to also to have a intergroup agreement that is a contract between the affiliated entities describing the legal framework of the transactions, but also the options to adjust the prices on an ongoing basis, and obviously also how the pricing works during the year, and at the end that you have the option to prepare the year-end adjustments. These agreements should be included in the transfer pricing documentation as well, and submitted to the tax authorities. Yeah, that's a little bit about the agreements. So we've talked about the arm's length principle. We have talked about the transfer pricing documentation, but and that is something that should be considered both during the year at the end. But in reality, transfer pricing is something that should be considered all year round. If you look down to the bottom left part of the screen, then you have the traditional work on transfer pricing documentation. But obviously before that, in order to make sure that we can conclude that we have been trading at arm's length during the year, then we should consider that a long way before. It's important to consider the pricing before we start the year. So, and during the year in the implementation and so on. Then it should be considered whether there would be any value chain optimization or adjustments during the year. It's not, as long as it's not aggressive tax planning, we can prepare documentation to also to have some advantages on the tax part. And then, when we are assisting our clients, we also help them a lot with not only documentation, but also doing transfer pricing audits, but and trying to mitigate the risks of the double taxation and also eliminate them through MAP and advanced pricing arrangement, where we can ask tax authorities to work together and to fix prices, either going forward in an APA or historically in a mutual agreement procedure, what we would call a MAP. The last slide is our approach to how to summarize the work on a full year basis, where we would start out with identifying a strategy within transfer pricing. How are we expecting to operate our business during the year, and from that we'll prepare our agreements, intergroup agreements, benchmarking studies, and we would like to identify what transactions we would have in general. Then we will have the planning phase, where we would obviously be pricing the specific transactions, and we will be implementing the strategy. And then during the year, we'll have the full operation phase, where we would do ongoing testing of the transactions, discussing whether there would be any restructurings and so on. And at year end, when everything has been finalized, when we have closed the books, we can start preparing the transfer pricing documentation. So if we consider the bottom part of this slide, imagine that you are in as we are now in 2022. This is what we would expect to be considering. So regarding 2021, we would have to maybe we should test the transactions with the benchmarking study and prepare some adjustments, and then we will prepare the documentation. And again, in 2022, we would be testing the transactions. We would be working with the transactions on an ongoing basis, and maybe the transaction should be in any way be tested. And then when we look forward in 22, we would also be budgeting the upcoming year. So hopefully now you have already been started to consider how to budget the next year, the coming year, and we believe that transfer pricing should be part of those considerations as well. Thank you.
Thank you, Christian. That was a lot of good information about transfer pricing and penalties and master files and the arm's length principle and also benchmark analysis. I have noticed that is an important thing. Thank you very much to Arne also and you. And we have some questions, but then I will hand over to Richard, and then we'll take the questions in the end. But please, to you participants, please do ask your questions, and then we'll take them in the end. And Richard, now the floor is yours. You can open your presentation, and then we'll go on with you and transfer pricing in Germany.
Yes, thank you very much, Nina. Welcome, everybody. So, I'm Richard Wellman. I'm going to talk about transfer pricing documentation in Germany today. I'm a partner in our Frankfurt office, and we have actually, just asking, can you see my screen, everybody?
Yeah, we can.
Yeah, okay. So we have a center of excellence, as it is called, for transfer pricing in Frankfurt. We have more than 25 offices in Germany, BDO, and we have 4 partners for transfer pricing in Frankfurt and about 20 colleagues working then with transfer pricing. So would be nice if I could also. There we go. Okay. So the agenda, what's on the agenda today? So it's about TP documentation rules in Germany, the current rules, what they are like, and the future rules that we expect to come into existence. It's about tax audit trends for multinational enterprises in Germany. And last but not least, cooperation across borders and how can BDO support your group with transfer pricing. So first to the transfer pricing documentation rules in Germany. Where do they come from? Actually, the taxpayer has an obligation to cooperate with the tax authorities, and the transfer pricing documentation rule, according to the German Federal Fiscal Code, is just an increased obligation of this cooperation. And in case there are cross-border intra-group transactions, the tax and certain thresholds are exceeded, the taxpayer may be requested to produce a transfer pricing documentation to the German tax authorities in a tax audit. So I think this already shows when you listen to Christian's and Arne's presentation about the Danish transfer pricing rules, that there's quite a difference. The German rules seem to be relaxed at first sight, at least. Only during a tax audit, a taxpayer normally is requested to produce transfer pricing documentation, or maybe asked to do so. Many groups, at least middle-sized groups, they have, let's say, the maxim, or they've never had a transfer pricing audit, and they said, well, we've never had one, why should we prepare transfer pricing documentation? So this attitude is still around, but I think it's changing, or has been changing over the years already. So if the German tax authorities come during a tax audit and they request transfer pricing documentation, the taxpayer has 60 days to produce this information and to hand over this transfer pricing documentation. And if extraordinary business transactions are concerned, it's a 30-day deadline that he has to comply with. Yeah, I already said there are certain thresholds that need to be observed. And basically they are quite simple, the rules. So it's 6 million euro threshold for goods, transactions with goods, supply of goods, intra-group and cross-border. And for all other transaction types, there's a 600,000 euro threshold. The question is, how do you calculate those 6 million and 600,000 euros? It's all in and outgoing cross-border intra-group transactions, and their volumes need to be added up. So if you have, I don't know, 4 million sales and 3 million purchases, for example, for one German entity, it's 7 million euros supply of goods transactions, and you would exceed the threshold. And then from the next year on, this entity would be obliged, if requested to do so, to produce transfer pricing documentation file to the German tax authorities. Basically, you don't only look at, if you have like more than one entity in Germany, you don't only look per entity at those thresholds, but you add up the different volumes. And this 600,000 euro threshold, it can be, for example, contract manufacturing services, intra-group services being provided, support services, for example. It may be interest charged, it may be royalties. So this all adds up and may exceed this 600,000 euro threshold. Basically, there is no need to hardly to prepare a master file and a local file in Germany. A master file needs to be prepared if the turnover of one German taxpayer exceeds 100 million euros, and that's the only threshold there is for preparation of a master file. And of course, we already heard that in Denmark, the thresholds are significantly lower than this 100 million euros. And it's for the whole group, the Danish thresholds, whereas in Germany, you always look at the German entities within the group. So the likelihood that, well, for middle-sized groups, let's say, that there is, under German rules, a need to prepare a master file is much lower than in Denmark, for example. And in fact, so we've had cases where the group only had German group entities. It's a middle-sized group, but there was only one legal entity outside of Germany in Denmark, and nevertheless, although this 100 million euro per taxpayer in Germany was not exceeded this threshold, so in Germany there was no need to prepare a master file, and there wasn't even a need to prepare a local file, because neither the 6 million euro good transactions nor the threshold of 600,000 euros for services was exceeded. There still was a need to prepare a master file in the local file in Denmark now for 2021, first time. So this was a not so good surprise for this group. Yeah, there are also penalties in Germany. For example, if the entity cannot meet this 60-day deadline, or let alone the 30-day deadline, and they are not really generous. 60 days seem a lot, but in Germany, unfortunately, so far tax audits are not really contemporaneous. It often happens that 5 years or longer back are audited in a tax audit, and then the problem may arise if you have not, if you don't have a transfer pricing documentation already on file, that you cannot find any or hardly any employees, at least in the accounting department or the tax department, that have been there 5 years ago and remember what had been happening and what agreements were in place. So this is like an exercise going back in time and trying to gather the information needed for transfer pricing documentation. And then 60 days are not a lot. So in case the transfer pricing documentation is late and the deadline is not met, there can be penalties of at least 100 euros per day and up to 1 million euros. Frankly speaking, and from the daily practice, do we see this a lot? I mean, we only deal with transfer pricing documentation and defense and similar topics in our transfer pricing center of excellence. No, we don't. We've seen cases where the tax authorities became quite angry at the taxpayer because he didn't meet the deadlines, and they fined him with 30,000 euros for a start. And then the taxpayer took up speed and actually presented this documentation quite quickly and agreed with the tax authorities. But it might also be, and this also happens, or we see this more often, that the tax authorities claim that the information provided in a document that's called transfer pricing documentation and submitted to the tax authorities is not sufficient. And the tax authorities claim that this information is not used. So in this case, it's not usable, cannot be used, and they would do, for example, their own benchmark, or they will make an assessment in this case. And then the burden of proof shifts, so that's what taxpayers should avoid, and they will then have to cope with the tax authorities' benchmark study, for example, and provide evidence that or substantiate that this is not correct what the tax authorities did. Yeah, and there can be fines in case in the end tax authorities really hold that the information provided is not usable and not sufficient for transfer pricing documentation. There can be penalty surcharges of at least 5% and at most 10%. And I mean, those penalties, they apply whether or not the German entity has some loss carry forwards or not for tax purposes. So yeah, this is really painful then. So that was just an overview of the current transfer pricing rules in Germany. And now there's a law in the making. It's called the law implementing the Council Directive on Administrative Cooperation. Actually, that's DAC or DAC 7 in the field of taxation and modernizing the law on tax procedure. And well, we can see that or expect that this law will enter into force until the end of the year, because DAC 7 is to be implemented into German law until the end of the year. And so far, both parts of this law have been kept together, and they have passed the Bundestag now and have been handed over to the Bundesrat to decide upon it. So I think the German legislator is on time here, and he will be able to pass the law until the end of this year. So what changes to expect? Actually, quite significant ones regarding the need to produce transfer or to hand over transfer pricing documentation to tax authorities, because tax authorities may then at any time request to be provided with a transfer pricing documentation, well, provided those thresholds that I already mentioned have been exceeded in the preceding year. And the taxpayer has only 30 days then to hand over this transfer pricing documentation. And also, if a tax audit starts, the taxpayer has 30 days or will have 30 days to then hand over the transfer pricing documentation. Also, there are some other changes, and I mean, regarding transfer pricing, there will be something called a qualified request for cooperation that's going to be introduced. And the non-compliance can be fined with amounts of up to 1 million euros. And what is a qualified request for cooperation? Basically, it's tax authorities requesting additional information from the taxpayer regarding transfer pricing. And if the taxpayer doesn't present this information within 30 days, he can be fined. So during the debate in the Bundestag, it was claimed that this is a rather one-sided law and the obligations are rather one-sided. It's all more burdensome for taxpayers, but hardly for the tax authorities. There are some deadlines for tax authorities that are actually set for the first time, but it's like a 5-year deadline, so it's plenty of time for tax authorities to audit transfer pricing. And also, as you probably know, in Germany, there's no deadlines for the tax, or hardly any deadlines for the tax authorities. It's not like they have, I don't know, 6 months or so to finish a transfer pricing audit. We've seen audits that have been dragging on for years, unfortunately, with the tax authorities, and more requests for additional information being filed or handed over to the taxpayer. So this is a little bit the music of the future, because the new rules are supposed to apply from the 1st of January 2025 on, and also for tax audits then for years after that start after the 1st of January 2025. But anyway, what you can see here from this law that's currently in the making is that it won't be sufficient anymore, as some taxpayers handle it currently still, to start to prepare transfer pricing documentation if the tax auditor asks for one. Tax authorities may at any time ask for transfer pricing documentation then, and the taxpayer better be prepared and have the transfer pricing documentation on file and updated also regularly, which means annually, because at the time being, it's possible to prepare transfer pricing documentation for a tax audit period. So you don't have to do this every year, at least under German rules, but you can, for example, take a 3-year period and prepare one transfer pricing documentation for all your German group entities, if this makes sense, for 3 years. Yeah, so we've prepared a little flyer. I'm sure Nina can also put it on the website, or we can send it out if you would like to receive it. So this is just a 2-page flyer with a summary in German or English of the current German transfer pricing documentation rules. Yeah, then let's come to the audit trends that we see for multinational enterprises at the moment in Germany. So there's a little small here, at least from my perspective. But anyway, trying to tell you what's on the graphics. So we see here on the first one the different sizes of entities and the years 2016, 17, 18, 19, and 20 with different colors. And we see the big entities, or the big entities and the middle-sized entities and the small ones. And we can see here with the middle-sized or with the big entities, we can see that there's a drop here in the bars that you can see, and that's the additional results from a tax audit. And you can see there quite a drop from, well, let's say 12 billion euros to 8 billion euros. Whereas with the middle-sized entities, you see that the additional results seem to be stable until the year 2020, more or less, there with little fluctuations. And then if we go to the right side, here to the right graphic, you can see different kinds of taxes and the additional taxes having been collected from the tax audits by the German tax authorities. And you can see here the corporation income taxes. So the corporation income tax and the Gewerbesteuer, the German trade tax. And you can see that they are quite high compared to the other taxes being shown here. So what we just wanted to, or what I just wanted to stress here with this, with these pictures or graphics, is basically that German tax authorities are interested in middle-sized groups and entities, and they're going to be more interested in the future. And why is that so? That's because the personnel and well, let's say technology is being updated with the German tax authorities, so they've been significantly upgrading personnel. It's been a problem sometimes in the past with transfer pricing documentation being prepared in English language and being presented to German tax authorities, not in the big cities, but let's say in the smaller tax authorities when they do the tax audits. And so the German tax authorities have been investing in new personnel and English-speaking personnel. And in particular, there are auditors that are specialized in cross-border transactions, Fachprüfer Auslandsprüfung, they are called, or there's also from the German Federal Fiscal Office in Bonn. There's special auditors that are being summoned then or sent to big tax audits in increasing numbers. So 2 years ago, it was said that 400 new tax auditors were being schooled in cross-border tax audits or cross-border transactions within multinational groups, rather just correct to say. And this is why we think this trend in auditing small and medium-sized or medium-sized groups will continue and increase. Also, there's higher results that are possible to be achieved by the German tax authorities from transfer pricing tax audit situations. And we can see some excessive requirements sometimes. Well, if German tax authorities think they are correct and let's say the EBIT margins abroad are too high from a German perspective, they sometimes, or we have seen excessive requirements by the German tax authorities and to evidence that the prices charged were at arm's length. So what are the top 5 transfer pricing topics that we have seen or that our clients have told us, or we've seen together with our clients? It's actually the profit margins then achieved, what I just said, that tax auditors for a start look at the EBIT margins within the group. And if the entrepreneur is a German group entity and you have, for example, project entities abroad with very high margin or higher margins at least than the German group entity and entrepreneur, the German tax authorities think this cannot be correct and they will try to tackle this. Also, the claim that the documentation is incomplete, that's what our clients have seen. And cost allocation agreements are also being one of the topics that German tax authorities like to go after. Also the arm's length of license fees, royalties being paid, and for example, the implementation or restructuring, let's say, and transfer of IPs. Yeah, and loans are probably going to become more interesting again to tax authorities with rising interest rates. So over the last couple of years, this has not been a big topic, but I think this will also change soon. Yeah, so how can BDO help you, and how does BDO cooperate across borders with transfer pricing? So BDO has a new claim, it's called Worldwide Closer to You. So transfer pricing fits in nicely with this claim. So let's see how we can support you. Christian has also already mentioned this three-tier approach with a master file, local file, or local files, and CBC report. The CBC, of course, is only for big multinational enterprises or groups with turnover exceeding 750 million euros. But the master file and the local file we see, well, almost all of the time. In particular, if you take a look at these relaxed, so to speak, German master file rules that I mentioned, the 100 million euro turnover, you will always have to check it with subsidiaries in other jurisdictions because the thresholds might be much lower or different anyway. Okay, so yeah, the master file can be used globally. Christian already mentioned that, and the local files need to be prepared per country, or as Christian put it, for Denmark, per entity even. So that's a customized approach that can be chosen just for the documentation. I mean, you as the groups, of course, create the facts every day that need to be documented then later on. So you know the facts best. And first, we would scope together with you actually what kind of transaction types should be documented, at least from a German approach. The transfer pricing documentation should be complete as regards facts. So also smaller volume intragroup cross-border transactions should be documented, but it's not necessary to document all transactions or cross-border intragroup transactions. So if the volumes are not material, normally we refrain from doing so together with our clients, of course, consenting. And the question is, how much risk is the company willing to take, and how much, how much it wants to be compliant, but how much money does it spend to be compliant. So this is something that needs to be taken into consideration. It makes sense, of course, to have the country start the master file preparation, and the country or the entities in the country where the ultimate parent entity is situated. So let's say if that's in Germany, it would make sense that BDO Germany then starts preparing or prepares the master file and also prepares local files. Maybe not only the local file for the German or for Germany, but also local files for other countries. As Arne already said, BDO has offices in more than 160 countries. So in most countries, there'll be an office of where group subsidiaries are, there'll be a BDO office. And in many offices, there are also specialists for transfer pricing. So, for example, BDO Germany could prepare the master file, and in agreement with you, your group, the local files for different countries as well. Of course, Germany or we in Germany only know German law, but we also know the OECD transfer pricing guidelines and rules. And so we could prepare local files that are OECD compliant, and this would be the lightest approach. But there are some countries, or maybe there are very high transaction volumes where a group then wants to have a review by the local BDO member firm. So this is at the latest where the local BDO member firm comes in. Maybe it makes sense if benchmark studies need to be prepared according to local specifics, or using databases that we don't use in Germany or we don't have access to bring in the other member firm earlier and provide them with a German module for a certain transaction type, and then have it not only reviewed but have it signed off or added to this module. Yeah, and there's also other groups, for example, after year one, when a transfer pricing documentation is prepared, that say, okay, we can roll this forward and we only need BDO to review this update that we do. So there's all different sorts of ways to agree how to save costs for entities and end up with a good solid transfer pricing documentation. So this is something that needs to be settled first, and then BDO Denmark, BDO Germany, whoever is the leading BDO member firm then in the process of a master file, local file, transfer pricing documentation can coordinate with the member firms abroad in the other countries. So this is just an example from an actual case. So the group decided here to prepare the master file themselves, OECD style, and it was then reviewed by BDO Germany. Of course, it can also be reviewed in other countries, for example, if there are additional requirements to fulfill. Then coming to the local files, we try to use increasingly a modular approach. So we have templates for master files, for local files, for different transaction types, royalties or purchase or sale of goods, distribution. And these can be used worldwide within the BDO member firms. So it makes sense if you have a number of different transactions to prepare modular or modules for the local file, and to have a template, because of course the transaction always has at least two sides. So it makes sense to also prepare the local file in English for a multinational entity, and then provide, for example, for the distribution activity, the module to the local BDO member firm and ask them to prepare the local file based on that and use the module, or to review the module and adjust it to the local special requirements. And the benchmarking, so we use BVD, Bureau van Dijk, the Orbis database and Catalyst in Europe, but for example in the US, it may make sense, depending on the transaction volumes, to use CompuStat, for example, or other databases used in the US, and then the local member firm in the US could prepare a benchmark study and provide it to other BDO member firms to prepare the local files, for example. So there's lots of interaction here, and this needs to be well planned. And if you want to prepare master file, local file template for the first time for a group, it takes quite a lot of time, as you can see, also to roll out then the review services being provided in different countries. For example, it takes a little bit of planning at the beginning if there are lots of transaction types, and also to see, to plan what needs to be documented in what detail in order to save costs here for the clients. Yeah, this is just a step plan, so to speak, trying to visualize here from the kickoff meeting to the submission of the transfer pricing documentation, the different stages and how to cooperate, or what the cooperation is like between BDO member firm and the client, then what steps need to be taken. But I think I already elaborated on that. And yeah, that's already us, the partners in the BDO Frankfurt office. And thank you very much for your attention. I'm looking forward to some interesting questions. answer them.
Thank you, Richard, for your presentation and all the information about transfer pricing in Germany. You have taken us through differences in master files and penalties and the regulations in Germany, and also the top 5 transfer pricing topics. And also thank you for your introduction to how BDO can help companies also across borders, because you are in so many companies, you are in so many countries. And I think that is a good thing for the companies to get help from you. And now, as you said, we are going on with questions. And if Arne and Christian also could turn on their videos and unmute them, that would be nice. And also to you participants, now you have the possibility to elaborate your questions. Some of you have written questions in the chat, and if you want to, you can elaborate on it if you unmute yourself. And you also have the possibility to be on with the video, but just if you like. And we can do questions in the chat, but also you can just ask questions now. But I will start with the 2 questions in the chat, and the first one is from Rune Agebo Jørgensen, who asked his question to Arne and Christian. When you talked about transfer pricing processes and that data analysis, he asked if you could give some examples of what large data could be.
Okay, thank you very much, Rune, for that question. So on that subject, we were discussing the new office within the tax authorities, trying to analyze the huge amount of data available in their perspective. So we had the slides with all the data which they will have available, and in a transfer pricing perspective, the most important part that they will have available will be the obviously the tax return. They will also have information about the controlled transactions. That would be something that would be submitted together with the tax return. In one form is the transfer pricing documentation in the master file and in the local file, but also as an appendix with a specific information about what about the type of transaction and the volumes of the transactions. That's the main sources of data that they will have available. They will also have information available if you during the year have transferred valuable intangible assets to other countries. Then your advisors are subject to submit information about this transfer, and also if you restructure a local entity, which would result in reducing the profit, the operating profit by 50%. That would also be something that would be stored in a database within the tax authorities. So that's the main points, but they will have much more than that. And please let me refer to the slide which Arne went through.
Yeah, thank you, Christian. I hope that answered your question, Rune. Otherwise, you can come with a new one.
Yes, thank you.
Yeah,
That's good.
And then we have a question from Michael, who asked, when you talked about the arm's length principle, he asked, what if we have a unique product we want to sell in a market to a customer with a loss locally, either to get in or to win a customer? Perhaps we will gain margin on other products for the same customer. Is this not allowed because we cannot document this in respect to the arm's length principle?
That's a good question, and thank you for that, Michael. Yeah, so the way that you would the tax authorities look at this would be if they would start out by understanding the business. So if you have a local entity having an organization locally, that would be their starting point. Part of that would also be the products which you are selling, and you're making a very good point. If the products are unique, then we might not have a source of compare from which we can extract data to compare with. And therefore, it might be that we would have to look into another method, another transfer pricing method, rather than looking at the specific price. Then it might be that one of the entities should be tested more on a functional basis rather than on the product itself, and that might lead to a scenario where you do not end up in a deficit. It is commonly it is common that we have this question regarding the loss and also the strategy behind it. I can only say that strategy is a part of a comparability, so it should be included when discussing the pricing and the transactions. But it would most likely lead to a separate discussion in order to determine what method should be applied. But we have 5 methods, and it sounds to me that there might be some discussions on the methodology on the transactions.
Okay, thank you.
Richard, do you have any comments on that?
Yeah, I think at least from a German transfer pricing point of view, if there's let's say a strategy to conquer a market with a certain product, in an overall perspective, I mean, there might be losses and they might be accepted for a certain period of time, but in the end, I think they should be compensated by higher prices then, so that overall there will be a profit achieved. At least that would be a German tax authority's point of view, I think.
Yes, because it might be that you could imagine that maybe the mother company in Germany are still earning money on the product, even if you have a local entity that is losing money. This is thought to be the scenario.
Mm-hmm. Yeah.
Okay,
Yeah.
thank you.
Yeah. And then we have the next question from Fritz Hildenstock, who asked, did I understand correctly that if you have a company working independently in Denmark without any transfer of work or products, no transfer pricing documentation is required in Denmark?
Yes. Well, the short answer to that question is that is correct. If you don't have any cross-border transactions, then you're not subject to transfer pricing documentation. But there's a however when answering this question, because if you are part of a multinational group, then we are experiencing tax authorities challenging not having any transactions at all. It would be very unusual not having any transactions if you are only one Danish entity, which is owned by a foreign multinational group. It might be that the entity should have paid or is paying management services. It might be that there would be some sales support functions or other functions that should be remunerated between the Danish entity and the foreign entity. So therefore, we cannot recommend purely to conclude that as you do not have any transactions, you are not subject to documentation. That might be something that I would recommend you to have a discussion with your local advisor on whether or not you in reality are subject to documentation, because that might lead to a high risk if you do not submit a documentation as we go into these penalty regime. That would be a shame if you have already focused your attention on transfer pricing.
Maybe just supplementing, if I understood your answer correctly, or your question correctly, was whether or not, I mean, when does something constitute an independent company from a Danish transfer pricing perspective? One should be aware that the definition of who is going to be comprised by we will call controlled transactions in Denmark is a bit broader than what you would normally see in, for example, consolidated accounts. You take into account more entities from a transfer pricing perspective as being part of what we call controlled transactions if they have like a shared shareholder group, or if they have shared management. That is also something that could constitute a joint control in Denmark, which could render those parties subject to Danish transfer pricing documentation requirements.
Thank you very much. Yeah, and Fritz also writes, thanks. I think you have answered his question. Now we don't have any more questions. I'll just ask the participant, if you have questions, and please write them in the chat or go on with video and unmute yourself. And otherwise, I don't know if you three, Arne, Christian, and Richard, have something to comment on your different presentations.
Well, maybe I do a question for Christian to elaborate a bit on. I think, Richard, you were kind enough to share some thoughts on the burden of proof from a German perspective. I think maybe, Christian, if you could add a few thoughts on how that looks from a Danish perspective.
Yeah. Thank you for that, Arne. And I agree. That's also something that is should be considered. If we look at the transfer pricing documentation itself, then a poor quality on the transfer pricing documentation would also lead to the shift in burden of proof. So the starting point would be, if you submit a transfer pricing documentation, then it would be up to the tax authorities to prove that the taxpayer has not been trading in accordance with the arm's length principle. However, if there's a lack of significant information in the documentation, and we park the discussion on penalties aside, then an additional issue would be definitely that the burden of proof would shift towards the taxpayer. And to add, we would the tax authorities in Denmark are able to go 5 years back in time, which in reality also affects the risk of double taxation even further.
Maybe, Christian, it would be worthwhile to add that if once the burden of proof shifts to the tax authorities, then unfortunately the taxpayer may be in a position where the tax authorities may then make their own assessment of what they think is the arm's length income, and then you are only in a position to sort of overturn that assessment if that assessment is deemed to be obviously wrong. So that is a sort of a relatively heavy burden of proof that could end up with the taxpayer in case the documentation is lacking or otherwise insufficient.
Good point.
Yeah. I don't know. Rick, do you have something?
I have a couple of questions. Well, the first one would be with the benchmarking. How often is there a requirement to update it, or is it possible just to update it, or do you have to perform a new benchmark study every year?
Yeah. That's a good question, Richard. The key issue is that you need data support to support the arm's length nature of the transaction. That's a requirement, and that should be included in the transfer pricing documentation. However, that data it is not specified what data exactly from which years and so on, but that would be a matter of comparability. And therefore, imagine if you have a 5-year-old benchmarking study that might not be just as comparable as a newly updated benchmarking study. We would obviously recommend to update the benchmarking study as much as possible, and the pragmatic approach would be to do it every 2 or 3 years.
But maybe to supplement there, Richard, to say that last year there was a change in legislation effective as of the income years that starts off by next year, by after the 1st of January, where it appears to be that the tax authorities are going to emphasize the need for benchmarking studies in such future transfer pricing documentation when compared to previous years. Exactly how much, I think, remains to be seen, but they did change the legislation to emphasize that they feel that benchmark studies may well be required for also the basic transfer pricing documentation, and not only in situations where you are asked to sort of elaborate on how you reach your arm's length analysis.
Okay. Thank you. And
Mike has a question.
Yeah, so Craig, I was just have a quick question. I was the intercompany transfer price we have between German headquarter and a subsidiary, for example, in Denmark. Is there any rules how often can we are allowed to change the discounts between the companies? Can we do this in a physical year every month, or is it only allowed to do every quarter or once a year? How is that?
Yeah, I would say as long as you believe that that change could be supported by an arm's length analysis, then you could change it. It would be subject to some changing a policy could be subject to other discussions, such as moving assets between entities and so on. But that aside, you might be able to change discounts on an ongoing basis. We would highly recommend, in doing so, to have a agreement in place between the entities, which underlines the way you operate, and obviously also follow that agreement as it is in writing. You can also change that. Then at year end, you would test the transaction whether you believe that you are within the margin, that the margins are within the benchmarking study, and you are actually able to adjust after year end if needed. And that is why you need this intergroup agreement, because obviously you don't have a full overview by the end of December. You would only have the overview once you have the financial statement of the entity, which can be tested. So you can adjust before you have prepared your tax return, of course. But please bear in mind, it might lead to other tax considerations that should be discussed with your advisor.
Mm-hmm.
To elaborate a little bit further, and also what Richard was talking about, what we really would like to do going forward within BDO is to help and to make sure that our clients have an overview of local requirements. Because imagine you have a big German-based entity, a group having small local activities. One country might be Denmark, and one country might be, Sweden or whatever. It's important that you have, on a yearly basis, have an overview of what are the local requirements, in order to avoid unpleasant surprises, such as as local penalties as we have here in Denmark. So an approach to this, and it might sound very simple, is to start with the beginning. And what I mean with this is to start with how do we believe that we can prepare a transfer pricing policy which is arm's length. So when you have the policy and the strategy around the transactions, it's much more easy when you reach to the end and you are supposed to prepare the documentation. If you start with the end, if you are only looking at the documentation, then all the monitoring during the year and the strategy and so on, it's much more difficult to sum up and to support the internal pricing.
Yeah, thank you. Do you have any other questions? I don't know if you have any other questions, Richard or Christian or Arne, to each other.
Yeah, I wanted to ask my colleagues, actually, is it possible to present the transfer pricing documentation, the local file, also in English language?
Yes. In Denmark, we can submit documentation in Scandinavian countries, Scandinavian languages, and in English. Unfortunately, they do not speak that much German. So,
yeah, we'll try to increase the business, and then
we'll see.
Maybe. Yeah.
If we need some translators.
Yeah. Do you have any other aspects? Now we have. No, it's just Rune who says thanks for the good session. He has to go. But do you have any other aspects you want to elaborate or take here before we end?
Maybe I have one more question to the colleagues from Denmark, and that's how about transfer pricing and criminal proceedings, or is that a topic at all, or are the Danish tax authorities so relaxed that you've never come across anything like that?
Maybe I'll start, Arne, and then you could elaborate a little bit. So the cases regarding transfer pricing penalties are looking at issuing penalties to the legal entity, not any persons for now. I don't know if you have any comments on that part, Arne.
No, not a lot. I think I agree with you, Christian. It is a matter for the business. I think there are sometimes some criminal law considerations in that the tax authorities are asking, or at least they are making the businesses aware that once they share information, they should be aware that that could be used to sort of increase or set a fine. And of course, and then you're also in a situation where if you don't share the information, then the tax authorities will make their own assessment. So how you are going about what information you wish to share, knowing that this could increase or create a fine for you as a business, versus not sharing information, that is sort of a consideration to be had, and that may also sometimes, depending on sort of the magnitude of what you're looking at, need the involvement of a tax lawyer with a criminal tax law experience. But we see it, but it is. I think we do have our views on that as well. Once we come across these issues.
Yeah.
Good. Thank you.
Yeah. Then I think if you don't have any other things, then I would just say thank you very much for presentations and also for the much information in this complex matter. You have taken us through a lot of different things, and it was a pleasure to have you here for this webinar. And also thank you to the participants for your questions. And afterwards, you will get an email from us with the presentations, with the recording, and also with the flyer from BDO. And yeah, thank you, Christian, Arne, and Richard. It was a pleasure. Very nice, also with all the questions and the different aspects from Denmark and Germany. Yeah.
Thank you.
Thank
Nice
you
to be
very
here.
much.
Yeah. Have a nice
Yeah.
day, everyone.
Thank
Yeah.
you.
You too. Bye bye.